There's an opportunity now to take a look at some stock picks in the AIM market, the market here in London, which used to specialise in small cap companies, but now there's over 10 £1 billion companies on the AIM market. Chris Boxall joins us from Fundamental Asset Management.
Hello.
Chris, welcome.
Hello.
Stock picks with you. I mean, I want to talk a little bit first of all about how your approach is, because you put together portfolios for people, don't you, of pretty much every single AIM stock that's available. Is that right?
Well, not so much every AIM stock. We run a portfolio service principally for inheritance tax mitigation. Investing in AIMs offers a terrific inheritance tax break, and it's been a fantastic place to invest over the last few years. So typically our portfolios run from circa 20 odd stocks up to around 35 for bigger portfolios of £600,000 plus. Largest AIM portfolio that we manage, AIM only, is circa about 1.5 million.
Okay, let's take a look at, you've put together a basket of stocks which you look through with us for a while now, and I think that's right. And if we bring up the list, I think we can see where we are in terms of some of the gains that we've had so far this year. There have been some pretty spectacular returns on this list here. And I think one of the other things you were talking about when we were last here is the fact that sometimes some of these stocks disappear for whatever reasons, don't they? Yeah. Either taken over or they go to the main market.
We had two takeovers, so we had to replace those. One of them replaced them was Patisserie Holdings. But yeah, other than that, the portfolio, the objective here was to keep it fairly stable, and a good example of patient long-term investing. So every quarter we may have some underperformers, but as has happened this quarter, a few stocks have caught up a little bit and outperformed the others.
Let's take a look at one of those. I know one of your stock picks for us today is Watkin Jones.
Yes, Watkin Jones is a construction company. And interesting news, you know, the last few months is there has been a big placement of the founder's stock. And that's often seen as a negative when there's a big insider placement, secondary placement. But Woodford Asset Management took up a big chunk of that, they're about a 12% holder. And the stock has actually continued to perform very strongly, and the inside the family still retains a circa 29% ownership. So that's still a material commitment to this 400 odd plus million market cap business. We like this business because it's unlike other construction companies on AIM. Its focus is on the student accommodation. So it builds a lot of student accommodation and it forward sells those to investors, so it de-risks it a lot. In addition to that, it's acquired a management company as well, so it manages the beds afterwards. So it builds them out and then has a long-term revenue stream managing these. And I think in a year or so's time it's going to be managing sort of 16,000 beds and growing. And that's very, very high margin, low capital area. We like it a lot. It's also moving into the PRS, the private rental sector as well. Therefore, it's a nice company, still not that expensive, trading at circa 12 times forward earnings, yielding, as we can see, 4%, and I like it a lot still.
Yeah, another big gainer there you can see at the bottom of the other column of stocks is Flowtech Fluidpower, another one you want to talk about.
Flowtech's a nice little business, been a bit of a laggard. Stocks underperformed. It is at its heart, the core business is a distributor of fluid power products, you know, pipes, valves, tubes, and it supplies hundreds of thousands of these things to tens of thousands of customers. So it's got a very slick distribution. It does very, very well, good operating margins, and it's been acquiring. Now the big news from the quarter with this one, it not only came out with results which were pretty good in quite a tough climate. You know, it's exposed to foreign exchange impact, and the economy's been quite tough in its space, but it hasn't stopped it acquiring. So it's using AIM for its purpose. It's going out, it's raised some more money, about £10 million, to give it some firepower to keep acquiring new companies, to plug into its system. Maybe it's looking at European exposure as well, and beefing that up. Again, it's not cheap. It's trading at circa 11 times forward earnings for the current year, just under 4% yield, terrific cash flow, circa 6% free cash flow. Again, a nice little business that we're still buying.
Yeah. Next pick, Bioventix. This is in the biotech space. This is another one you can see here, 40.7% on a year-to-date return. A tremendous return for those in the stock already. Explain a bit more about what it does.
It's a tougher one for me to explain. It produces monoclonal antibodies which are used in testing, immunodiagnostic testing, and it provides those to the big immunodiagnostic machine producers, Siemens, Roche, Abbott, so very few, very large customers. What it does have, when an antibody that it's produced is plugged into these customer systems, has a very long-term revenue stream until it falls out of royalty effectively. Therefore, it's very reliable in terms of cash generation, very little capex, very few people employed, and it's got an extraordinary model. If you look at its income statement for a 100 million market cap company now, you see a tiny top line of just over £5 million and a 4 point in revenue and a 4-point-something million pre-tax. It's extraordinary, and that all falls through to cash. So free cash flow yield is just over 4%. And it has this long-term revenue stream. And the news recently was that Siemens have just launched a test, a troponin test, which will use Bioventix's antibodies, and that's really stepped in just at the right time, because another stream was coming off royalty. Therefore, it's looking pretty positive for Bioventix, but it really does take a little bit of believing if you look at the numbers to think this is a 100 million market cap business, very focused. Management, pay themselves in relative terms compared to a lot of AIM companies, real pittance as well, which is all credit to them.
It's interesting actually, these biotech companies, London's not really the natural home for biotech companies, or certainly hasn't been in the past. It's interesting to see some of these smaller companies grow in size. But the problem is about that is it goes back to our point about the fact that AIM companies become takeover targets. Do you see this as a potential takeover target by some of the bigger companies that might want this sort of technology within their stable of offering?
In reality, it's really a private company with a listing, this one, and if anything, it's easy to say in our comfortable offices, but it could have been perhaps more adventurous with its cash. Rather than paying out a divvy, looking to acquire other things, which it hasn't. So is it a target? The big player on AIM is Abcam, obviously, who are in their space. Abcam's a huge success as a distributor as well as a producer.
I think that's £1.7 billion worth of value, isn't it?
Absolutely. It's one of AIM's great success stories. Bioventix, you could say maybe with a different structure, being harsh, being brutal, could be more adventurous, but look what it's delivered to shareholders. I don't know if it could be. It's very much one man's baby as well, whether he'd be interested in being taken out. What's he going to do with the money, for a start?
Let's move on to your last pick, which is smart metering services, or SMS.
Yeah, SMS has been an underperformer in the quarter, and as the name suggests, it's in an area that is very hot at the moment. Most of us are getting exposed to smart meterings, for better or worse, and some are having bad experience, others good ones. Long term, we think it could be very good for the consumer to have a more accurate control of our energy consumption. Now, smart metering is a fantastic offering. It's largely debt funded, very cheap debt. It's circa 1 3/4 over LIBOR. It's got a near 300 million debt facility. So it is responsible for setting up all the connections, then owning the meters from which it generates a long-term revenue stream. Bear in mind, we reckon it's got a market opportunity of in its space of 22 million meters, for argument's sake. If it can take 10% of those, and by the way, it's very good at what it does. That's 2 and a bit million meters. It's already installed 1.2 million meters. It's got debt to put in all the others. And it does it very well. It's importantly, it made an acquisition, well, a couple of acquisitions a year or so ago, of installers as well. So it's not only got the meter, the data bit, it's got the installation wherewithal as well, and it's got a training centre. You can imagine the number of smart meters we've got to install in this country. You need to have control over your installation process. It's come off a bit over the last quarter. We think could be a good buying opportunity. Not cheap on an earnings level, but when it stops, installing these, you can imagine the cash coming off this thing. It's just taking a rental for forever and a day on these meters.
Interesting. Okay, all right, Chris, thanks indeed for joining us for this look at some of the stock picks from Chris Boxall's fundamental asset management portfolio of AIM stocks.